Let's go ahead and go through the solution to the problem involving the sale of the differential asset when a separate accumulated depreciation account is used. And as always, we've got a bunch of random numbers here, and the first order of business, copy, and paste as values. That makes them all not variable. Okay, so we have on January 1st, 2020, Big acquired 80% of the voting stock of Little Company. At that time, Little's equipment was undervalued by $35,319. The equipment had a remaining useful life of 6 years. Goodwill in the amount of $28,199 was recorded at the time of purchase and remains unimpaired. The equipment had accumulated depreciation of $15,530 at the time Big acquired Little. And on May 1st, 2022, so 2 years and 4 months later, Little sold the equipment at a loss of $73.47 even. On January 1st, 2022, Little had common stock and retained earnings of $142,750 and $156,428 respectively. During 2022, Little reported income of $57,252 and paid no dividends. And down here, let me make this bigger. There we go. Down here we have the annual depreciation of that differential. That's simply the amount of the differential divided by the 6-year life. Okay, so 5886.50. Okay, so we need to go ahead and do our elimination entries for this, and really most of these amounts can simply be pulled right off of the information there. Common stock at acquisition, $142,750, or sorry, common stock at the beginning of the year. Retained earnings. Goodwill is that. Now, as far as the equipment and its differential are concerned, we can do this one of two ways. My preference is going to be to go ahead and write the equipment up by the amount by which it was undervalued, and then realize that that has been written off over the past 2 years, 2020 and 2021, at the rate of $58.8650 per year. So we'd be carrying forward accumulated depreciation of $11,773. So this total value, whatever these things add up to or net out to, is the beginning of year book value plus the remaining unamortized differential, and that's going to be split 80-20 between the parent's investment in Little and the non-controlling interest. So let's see, let me go ahead and try to tidy this up a little bit. I'm going to pull these out here. There we go. So the investment in Little, they're going to get their 80% of that plus that plus that plus that minus that. The non-controlling interest gets the other 20% of that plus that plus that plus that minus that. Okay, we also have to do that elimination entry to eliminate the date of acquisition accumulated depreciation. So we're going to go ahead and debit accumulated depreciation for the date of acquisition accumulated depreciation and credit the equipment for the same amount. And again, that entry is going to be repeated every year for as long as we own the asset. Okay, now we need to do our depreciation for the year. Now here's where you need to be a little bit careful. The annual depreciation is $58.8650. We're only taking depreciation for January, February, March, and April, 4/12ths of a year. 4/12ths being the same thing as 1/3, obviously. So 1/3 of that, and we're good. Again, that's 1/3 the annual depreciation. Now we get to the part where we need to record the effects of the sale of this asset. Now again, think of what we've got here. We started off with a differential of about $35,000, and we've written that off at $58.8650 per year. So we had written off $11,000 of that previously. We just wrote off another about $2,000, and so we've written off about $14,000 of that $35,000. The other $20,000 hasn't been written off yet, and we're going to write that off now as an adjustment to the loss on sale of the asset. How are we going to get that number? Well, basically, this asset's been sold. All evidence that this asset exists needs to be eliminated from the balance sheet. So we've got those five little boxes that I've highlighted there. Those are all debits and credits to either the equipment or the accumulated depreciation. Those need to go away because the asset is no longer owned. So first, for the equipment, we have a debit of $35,000, a credit of $15,000, a net debit of about $20,000. We need to get rid of that. So we're going to go ahead and credit equipment for that minus that. Same thing with the accumulated depreciation. Accumulated depreciation we credited for $11,773. We debited it for $15,530. We credited it again for about $2,000. And so we're going to have a slight positive debit balance when we net those things together. So what have we got? We've got that minus that minus that. And basically, these two things combined, that's the remaining unamortized differential that we're going to carry forward and now write off. And so that's going to be the adjustment to our loss on sale. Now we need to go ahead and do the investment income and the income to the non-controlling interest. Basically, the parent's investment income is going to be their 80% of the subsidiary's adjusted / realized earnings. So we start with the reported earnings, 57,252. I always do that. So we start with the reported earnings, and we look at the elimination entries and say, okay, we lowered income because we increased depreciation expense, so we subtract 1962. Then we lowered income even further because we added this loss on sale. So 80% of the adjusted earnings is 26,964, and that's going to be the investment income that we're eliminating. Same drill for the income to the non-controlling interest. They're going to get their share, 20%. Of the subsidiary's adjusted earnings. We start with the reported earnings, subtract out that additional depreciation expense, subtract out that additional loss, and we get that. Come on. Okay, so there's our solution to the sale of the differential asset when a separate accumulated depreciation account is used.